Right guys, so the second video, we're going to be taking a look at what is a pip. Now again, if you've been in and around the industry for some time, you'll know exactly what a pip is. But if you're new to the space, new to the industry, again, it's going to sound very, very alien to you. So what we needed to do was explain this for you guys. So a pip is essentially the fourth decimal place in the numeric value that expresses the exchange rate between two currency pairs. This is what we'll be using to measure small price movements throughout the market. But again, without overcomplicating things, the easiest way to explain what a pip is and how we calculate it is going to be over on the chart. So let's take a look.
Right guys, so now you join me on the charts and we're going to be having a look at pips in a little bit more depth. Now, some people when explaining this will really overcomplicate it, and what I'm going to do is just break it down in its simplest form so it's really, really easy to understand. Now, if we look down the right-hand side of the chart here, we can see we have this scale with different numbers on it, and this is actually the price of the currency pair in question. And you can see that the current price is actually 128.950. Now, what I've also done is mark off a number of different levels on the side of the scale, and the current currency pair is Euro Japanese Yen. Now what we're going to do is have a look at Euro Yen, Euro Dollar and Gold, as they will look slightly different on the scale, and we want to kind of clear it up so that there's no confusion. So with Yen pairs, what we're going to typically see is we have three numbers and then we have our decimal point followed by another three numbers. Now, with some other pairs, we may have two numbers before the decimal place, one number before the decimal place, and gold actually has four numbers before the decimal place. Essentially, it's all the same thing, but what we're going to do is just clear it up so there's no confusion. So getting back to these numbers down the right-hand side, you can see that from 131.600 to 131.200, we actually have a 40 pip difference. So if we actually look at the scale, we can see that it's a 400 difference. So we can see from 200 to 600, we have a 400 difference. But all we're simply doing is just dividing that number by 10 and it gives us 40. We can then see that we have 131.200 to 130.200, and that's giving us a 100 pip difference. Now again, from 130 to 131, we can see there's a 1,000 difference, and we're just dividing that by 10. And then from 130.200 to 128.700, we have a difference of 150 pips. Now, that's pretty simple, I'm sure you'll agree. And it's just a case of counting the numbers down the side and dividing it by 10. Now, if you are struggling with this at the beginning, what you can use is the price range tool. Now you do find this down the left-hand side of your screen usually, and we will cover how to find that and how to set it up properly on the TradingView setup video. Now it does look like this, where we have a line and a circle at the top, a line and a circle at the bottom, and an arrow in the middle. And what we can do is click on our screen and drag it up or down, and you can see there that there's actually a number at the top on the right-hand side that's changing as we drag it. So from this point here to this point here, we have a 290.7 pip difference. So what that's going to do is it's going to calculate the pips for us. So for example, if I drag that from the bottom of this 150 pip range to the top, you can see it's giving us 150 on the side. If I drag it from here to here, it's going to give us 100. If I drag it from here to here, it's going to give us 40. So you can see that that tool works an absolute treat for helping you spot that in the early days. And over time, it's just going to become normal. It's going to be second nature. You're going to be able to look down the right-hand side and say how many pips it is. But in the early days, this tool's just going to give you a little bit of a hand and help you work that out. Now, what we're going to do now is have a quick look at Euro Dollar. And as you can see, looking at the scale, it looks slightly different. So we have one number, then the decimal place, followed by more numbers. Now, essentially, it's exactly the same thing. So what I've done is I've marked off two price points again. We have 1.18750 and 1.17750. So what we can see is there's a 1,000 difference again on the scale. So all we're going to do is just divide that by 10 once more. And as you can see, if I drag that from the low of this range to the top of the range, we have 100 pips range. So again, very, very simple. It looks a little bit different, but we didn't want to have any confusion there. We want it to be as obvious as possible. So very, very simple stuff there. And what we're going to do finally is look at gold as it is a little bit different. So for example, if we type in XAU USD, which is the symbol for gold, it brings up a list like this. And this will happen whenever you type any currency pair in. It will bring up a list of different exchanges. So for example, you can see we have Oanda, forex.com, IDC, Saxo, Global Prime. So they're all different exchanges that offer the charts for this pair. Now, typically we do use Oanda for the majority of our currency pairs as it is more accurate. However, for gold, I like to use IDC. Now, what we can see here is, again, the scales look slightly different once more. We can see we have 4 numbers, then the decimal point. Now, again, this can cause some confusion, but I just want to kind of show you how simple it is and how we just repeat the same process. So for example, if we look down the right hand side, I've marked off 2 price points. So we have 1850 and we have 1830. So what we can see is there's actually kind of a 20 difference. So we can see 30 to 50 is 20, okay? But what that actually is it's already divided by 10. So we need to times it by 10. And there's actually a 200 pip difference on the scale. And this is where things get a little bit confusing on gold. Now, if I drag out my price range tool from here to here, you can actually see that we have 2000 pips on the price range tool. So it's completely up to you how you want to work this out. But how I go about it is I will always drag my price range tool and I'll simply divide that by 10. So for example, from this point here down to this point here, you can see that we dropped 10,314, whereas that is now essentially 1,031 pips. So you can see, again, it's just a very, very simple case of dividing by 10. So hopefully that makes sense. It is a little bit different. It can be a little bit confusing in the early days. So for example, let's have a look at that from a trading point of view and how we can actually use that. So for example, if we was going to look to take a trade from this area here, what we could do is use our short position tool from this area. And if I drag the bottom out, this would be, where our profit goes. So we're looking for a sell position or a short position, and we're wanting the market to push down like so. And as we can see, the pips is kind of in the middle there. And that is 7,842, whereas we know that we just divide that by 10, so we have 784.2 pips. Now, as you can see, we have a red section on this position tool as well. And this would essentially be, where our stop loss is. And if we're in the red, we're running in a loss. Now, as you can see, if I drag this to, let's say, 480 pips, and I have the stop loss to 480 pips, you can see that it's now what we call a 1-to-1. So we can see that if we enter the market here and it pushes in the wrong direction and it goes and hits our stop loss, this is where the trade cuts for us and we lose 480 pips. If the market pushes in our favored direction and I take profits here, it cuts us out the trade in a profit, again, we're making 480 pips. However, what is that? How do we calculate how much money we're going to make on our account based off pips? Okay, we don't really. What we use here at the Social Traders is we use percentages to work out our returns. So for example, we use 1% risk on every single trade. So if we have a £1,000 trading account, we're going to risk £10 on every single trade. So if the market moves against us, we lose £10. And on this example, if it goes in our favor, we win £10. Now, what we can actually do is improve our risk to reward. And again, we get onto all of this much later on in the course and how we can really, really increase and maximize our risk to rewards. But if I now start to drag the stop loss down, you can see how the risk to reward is increasing. So when it was like that, we had a 1-to-1 risk to reward, so 1 risk for 1 reward. If I drag that down, you can see the number starts to increase. Okay, so if I drag it all the way down to here, you can see now we have a risk to reward of 1-to-2. So if it goes up here, we lose 10. If it comes down here, we win 20. So you can see how risk to reward is such a huge part of trading as well. And we will cover this much later on in the course. But what you can see is as I drag this smaller and smaller, and I drag the take profit further and further, the risk to reward continues to increase. So this is how we actually calculate it. We don't really calculate it based on pips, but what we can see is pips are still a factor. So down here we have 8,566 or 856 pips as a profit target, and we have 132 pips as a stop loss. Now, when we're working out our position sizes, and again, we'll get onto this a little bit later on, we need to understand how many pips our stop loss is and how many pips our take profit is in order to work out the correct risk and the correct lot size for our trade. So that's why it is so important. But hopefully that gives you an insight into how we can calculate pips, how we can use a little bit of a tool just to help us in the early days, and then how we actually go on to work out how we trade, how we're going to make profit from the market. We don't calculate it based off pips, we calculate it based off percentages. So hopefully that helps, guys. Let's get on to the next video.